Hello, this is Mike Bernick, your host for today and also your voice for all of the great questions you've been asking Dr. Weiss and Mr. Sagami about the Weiss Ultimate Portfolio, the investment strategy we have just opened up to our best customers this week. Now, all week long, our inboxes have been packed with your comments and questions, and I really like the quality of those questions. They tell me you're very aware of Dr. Weiss's cycle forecast and how they are now coming to a head. In fact, you see it everywhere in the news. You can almost feel it in the air. I think your intense interest also reflects the amazing performance they've achieved. 722% portfolio growth since 2007. That's 67.2% average total return per year, over 4 times better than Warren Buffett's Berkshire Hathaway. So today, Dr. Weiss and Mr. Sagami are going to answer the most frequent questions as best they can. Are you ready, gentlemen?
Absolutely.
Same here.
Okay.
Call me Martin, though.
Will do. Sure, Martin. Let's start with some questions related to all of the big numbers that you've given us this week. I think there's a lot of people that have really been surprised when you talk about a total return of 722%. So one question we're getting a lot is, how consistent was that growth?
I'm the numbers guy, so let me take it.
All right, Tony.
The performance numbers have been very consistent, but rather than talking first about our best years, let me tell you about our worst year, which was 2008. That was in the depths of the most severe recession since the Great Depression. Our model portfolio was down 6.1%.
Okay, let's compare that to Warren Buffett.
In that same year, Warren Buffett's Berkshire Hathaway was down 32.1%. So our loss was over 5 times smaller than Buffett's. And on the flip side, our total average return for the entire period, including the Great Recession, was a positive 67.2% per year. So year by year, our average gain has been nearly 5 times larger than Buffett's.
So the losing year was 5 times smaller, and the average of all the years was 5 times larger.
Exactly.
Okay. Martin, let's talk about retirement. Obviously, we all know you're still going very strong, but you know, a lot of our questions from readers are those that are planning for retirement or are already in retirement now. So this kind of growth is very intriguing to them because the other solutions that they're seeing out there are really just unacceptable. One woman here asks, which solution do you choose, Dr. Weiss? Ridiculously low yield or ridiculously high risk?
Well, neither, of course. With the first so-called solution, you're supposed to plop your money into a bank CD or something equivalent. But what good does that do you? Even if you have a nest egg of, say, $500,000, and even if you could find a bank that gives you 2% interest, all you get each year is $10,000. How the heck do you pay the mortgage and buy food with $10,000?
Gee, all you need is 1 or 2 MRIs that Medicare won't cover, and poof, all your income's gone.
Right, and the second solution is even worse. You go for a high-risk strategy of some kind, and you get caught in a bear market or some other unexpected event, and suddenly your principal is gutted in half.
Which sets you back even further.
Right, so now with, let's say, with half of your principal gone, then you go for the low yield option? Heck, if you do that, how long is it going to take you to recoup? I mean, just to get back to square one. Do the math, Mike. I mean,
well, you've lost $250,000 and you still have $250 left, half of your money, as Tony pointed out, and you want to recoup your loss so you can get back to break even. And you're making how much? 2% per year?
2%, right.
Okay, so $250,000 times 2%, that gives you $5,000 in interest per year. And you want to recoup your loss of $250,000, so you know, really just divide 250 by 5 and you can see that, wow, it's going to take you 50 years to get back to break even. That's mind-boggling, if not impossible.
It is. It's ridiculous. And this is the great dilemma of our times. So the only true solution is something that gets you away from these absurd, I call them Faustian choices. You need something that takes you to an entirely different plane. And that's what our goal is here. Faster growth without bigger risk. In fact, with a lot less risk overall.
Right, very well said. The next question here comes from a reader who apparently knows you as a publisher, but not yet for your work in founding Weiss Ratings. He's asking about your background. So Martin, why don't you share with our viewers how you founded the company back in 1971?
Yes, it was 1971. That was the year I founded my company, and that was over 4 decades ago. And 6 years before that, I put myself through college by working with my father as a writer and as an analyst in his investment research company. And then after I graduated, that's when we started working together to develop the Weiss Ratings.
Mm-hmm. From everything I've heard, that must have been quite an experience.
It was. You know, Dad wasn't just a good father, he was also a good friend, teacher, mentor, partner. And working closely with him wasn't just a great education for me personally, it was also a great education for all our researchers and analysts working to develop the Weiss Ratings, especially Tony.
You know, he was like a father to me, Martin.
Yeah.
To everyone on the Weiss team, especially to me.
Yeah.
Sure. Yeah, I've read your book, Martin, and it seems that your dad was probably the only person in history who saved investors from the bear market crash in 1929 and then saved them again from bank failures in the 30s.
Yes, but that's true. But what some people don't realize is that even in the Depression, he was also one of the very few to pick the bottom and get his clients back into the market. I have a chart here, and right here on this day, you can see when he started buying. He got them into blue chip stocks right near the bottom of the big decline. And we also have some other charts to illustrate this. There's another one right here where he helped investors like Bernard Baruch pick up gold stocks right around this point where the red arrow is pointing. And those stocks, those gold shares, doubled and doubled again. He advised Joe Kennedy, the father of JFK, to buy silver when silver was selling for something like 20 cents an ounce. He told clients to buy America's best electric utilities when the utilities hit their rock bottom, which was a few years later, just before World War II. No one wanted utilities back then, so they were selling for pennies on the dollar. But all that was before I was born. I didn't come along until right after the war. And as soon as I was old enough to understand, my father began telling me bedtime stories about his exploits on Wall Street. And he made them very exciting. So as soon as I could do arithmetic, he began to show me how to analyze companies, how to rate them. That was his great skill.
Okay. Now, Martin, you've just opened enrollment for the Weiss Ultimate Portfolio here. And one gentleman who saw your last video is asking, Martin, you've introduced us to other services, but in this one, you seem to be much more involved. Why is that?
Good question. Well, it's because our Ultimate Portfolio is the fulfillment of a lifelong ambition for me, like a lifelong dream. To me, it is the ultimate reward, a pot of gold at the end of a long journey. Because you see, for many years, my father and I did all this manually. We manually analyzed just a handful of companies every quarter. So my dream was to develop systems that could help us accurately review thousands of companies every day, and then create a portfolio around that. And for the last 30 years or so, what we've been doing is leading teams of analysts and computer programmers. Tony was in charge of the team for mutual funds, now ETFs. We had another team for stocks, plus another one for banks and for insurance companies.
To generate ratings on them.
To generate ratings on them, exactly.
To build smart, very smart computer models that issue accurate ratings, that was many years ago. Now, for the past decade and a half, we've been validating the accuracy of the stock and ETF ratings in real time. And now, based on that experience and with many years of data, we have it as close to 100% as we can get. So we can say with a high degree of confidence that the place and time is here and now. It's finally the right moment to open up an ultimate portfolio under the Weiss Ratings umbrella.
Okay. So what's your role, Martin?
Well, I oversaw the development of the program. I've handpicked Tony to be in charge of its implementation, and I'm investing it myself also with my own money.
So while we're on the subject of the Weiss stock ratings, I have a question of my own for you. Now,
Okay.
the Wall Street Journal once reported that the Weiss stock ratings beat everyone, that your ratings were #1 in the nation in terms of performance. I have that report right here.
Yeah.
You beat the research departments of Merrill Lynch, of Goldman Sachs, and really every major Wall Street brokerage firm or bank in the study. Why is that? What gives you that edge?
Well, you know, it's not so much what we know, but how we know it and how we use it. Let me explain. The main reason is that the Wall Street firms were conflicted. In effect, they got payola for rating the companies in the form of underwriting business.
Right.
The more underwriting business that a company would give them, the higher the rating that company would get.
But in the same Wall Street Journal report, your stock ratings also beat all the independent firms who did not have conflicts of interest. So why is that?
Well, since Tony was the first team leader for the Weiss investment ratings, I'll let him take that question.
Well, you know, I'd bore you to death if I went into the fine mathematical details. But I will tell you this, a big reason is because of safety. And safety is such an important part of what we do. The other research firms that issue ratings, whether they're conflicted or independent, typically focus mostly on profits.
Nothing wrong with profits.
No, we all love profits. But we look very, very carefully at both profits and safety.
Makes sense. Here's a question we get all the time about ratings. I know all about your Weiss ratings and I use them all the time, but with your Ultimate Portfolio, it seems you're taking a step further.
Yes, a giant step further. Our Weiss Ultimate Portfolio goes far beyond our published letter grades because it ranks the stocks by a proprietary index that we do not publish.
So it's not a rating in this case, it's a ranking on top of the rating, right?
Yes.
Yes. Yeah.
I'm talking about our performance index, which is a model based upon how much money investors are making in the stock right now. That way, we seek to focus strictly the top performers among the 730 or so stocks that we consider safe and liquid.
Okay, good. You know, we have a lot more questions here from our readers, so let me just quote them. Let me be their voice, so to speak.
Go ahead, that's a good idea.
Okay. You talk about wars and the terrorism, and you say it's going to get worse. So why invest in stocks to begin with? Shouldn't you just be buying things like gold?
Well, we do that too. Whenever a mining stock appears in the top of our list, then it automatically is a great buy candidate. And ditto for the precious metals ETFs. You know, they have gold ETFs, silver ETFs. So, but when it comes to buying other stocks, any stock, please keep this in mind. The turmoil, almost all the turmoil, is overseas. So it's driving a flood of smart investors with a lot of money into U.S. markets. And what are they seeking to buy?
Well, quality, I presume. They're running away from risk, so they're looking for the highest quality investment.
Yes.
There you go.
They're looking to buy the best, most liquid investments they can get their hands on. These are the same kind of investments that we buy, but we have a big advantage over them because we have such powerful, accurate selection tools.
Okay. I've got an IRA. Can I trade along with your Ultimate Portfolio?
You bet, you bet.
Sure.
Every investment we buy is suitable for IRAs. Besides, this is not a high-risk strategy that goes for flashy one-up trades. It is designed to build wealth rapidly, but to do so steadily over a long period of time. And you can do this especially well in a tax-protected account like an IRA.
I'm a member of your Supercycle investor. How does your Ultimate Portfolio fit in?
Both services are based on the same vision of the future. Both services harness that great power of the money tsunami that's flowing into U.S. markets. But, you know, they're also different in key ways. I like a Supercycle investor because it can give you very nice bursts of profits in a very short period of time on individual investments. I like our Ultimate Portfolio because it builds your core money, your savings, very nicely over time. So it would make a lot of sense to get both services, and it would also be fine to take just one.
Okay. Here's a question for you, Martin. Your father is legendary for having made a killing in the bear market of the 1930s, but making a killing in the next stock market crash, whenever that may be, doesn't seem to be your primary goal. Why not?
You don't have to. In bear markets, all you need to do is preserve your capital. And that alone puts you well ahead of everyone else in the market. And then when the market recovers, you can truly jump far ahead of the averages. I mean, the numbers I've given you for our model portfolio prove both of those points.
What is a prudent strategy for a bear market?
Well, before you go there, you need a model that helps you do what Martin's father did, which is accurately identify the beginning of the bear market as early as possible and the end of the bear market as well, so you can pick up the bargains and get on board for the recovery. That's what we do with our model, based largely on the same indicators we gave you in our prior briefing. These bookends, marking the beginning and end of the bear market, aren't going to be exact.
Right.
But still, knowing them makes a huge difference. Then the bear market strategy is basic. You allocate a lot more to cash, you use solid defensive investments and hedges, and you're going to preserve your capital and even make a little money.
Yeah.
Makes sense.
Exactly.
In his War Room briefing, Martin said that one of the mistakes many investors make is to invest strictly in stocks. He said they should spread their investments across various asset classes. How do you do that?
You know, the ETFs that we use in the Weiss Ultimate Portfolio represent every single asset class you can think of. And that's including gold, silver, commodities, real estate, bonds, you name it. But like every single investment, before you buy it, it's got to meet two simple, logical preconditions. First, it has to be liquid, easy to buy and sell. Second, it has to rise to the pinnacle, the extreme top of our charts.
Okay. I want to do this on my own without following your portfolio. Is that possible?
Yes, up to a point, Mike. All you have to do is make sure you stick strictly to our buy-rated stocks and then stick with the ones that are very liquid.
And what's your definition of liquid, Tony?
A stock that has at least an average trading volume of 250,000 shares a day and a total market cap of at least 500 million or more. But now let's talk about the next step, which could be a bit difficult to replicate on your own, because that's where we rank the stocks using our unpublished performance index.
Martin, why isn't it published?
Good question. Fundamentally, it boils down to our two goals. The two goals I set forth when I first founded the company. We want to do everything we can to help save the public from losses. That's what is the primary goal of our published ratings. But we also want to provide very specific investment recommendations to help our closest friends and subscribers build their nest egg as efficiently as possible. And for that second goal, our performance ranking model is far more powerful if it's not published, if it's not being used by a larger number of investors in the marketplace.
Okay. I can't afford to stay glued to my email all day, every day, waiting for the next trade.
I can't either, actually.
Well, that's why you just need to check your inbox every Friday afternoon to see if we have a new recommendation or a change to your portfolio.
Okay. What's the minimum amount of money I need to invest in order to fully follow your ultimate portfolio?
Sure, probably $25,000. That's more than enough to diversify across all the investments we recommend and still maintain a cash reserve for safety or for taking advantage of new recommendations.
And how long will you be in any one position, Tony?
You know, it just depends on how long the stock or ETF stays at the top of our list. The key is we never try to tell the market what to do next. The stocks and ETFs themselves tell us whether or not they're worthy of our money.
Beyond your buy and sell recommendations, what else do I get as a member?
Well, that answer would be too long for this forum. All the benefits are on our website, but if you still have further questions, just give us a call.
And do you offer a money-back guarantee?
Yes. Take as long as you need. Follow us as faithfully as you can. Take full advantage of the service for as long as you want. At any time, if you want to quit for any reason, just let us know, and I'll make sure you get 100% of your money back on the unused balance of your membership. That's our way of saying that we trust you and that you can trust us to make this work for you.
Okay. Martin, Tony, this has been very helpful. Now, our viewers should be able to get answers to most of their other questions in your special report, correct?
That's right. That's why we have a button below this screen for more information. And if you click on that button, it takes you to our latest report and our website that answers virtually all your questions.
Great.
The website includes my dad's story, my story. It tells you about all the member benefits, pricing, how to order, and our anytime unconditional guarantee. Read the guarantee carefully. I think that will give you an idea of how strongly I feel about this.
Okay, well, thank you, Martin, and thanks, Tony.
My pleasure.
Thank you.